A new dollar system is being quietly tested right now, and it does not need your permission. While you're counting cents at the grocery store, a handful of countries are running experiments on the very mechanism that makes your paycheck matter. And here is the part nobody wants to say out loud. If the world ever stops treating the Fed as the default referee, your savings will not just lose value, they will lose meaning. This is not financial advice, this is financial education. I want you to picture the last time you felt calm about money. Maybe it was when you got a raise, or when you saw your bank account finally stop shrinking, or when you told yourself the worst is over because inflation came down. Now zoom out. In 2026, the fear is not just inflation, it is that the rules of the game are being rewritten in real time by the same people who profit every time you flinch. You are going to hear a cold walkthrough of how modern financial power works when ordinary people think the system is neutral. We'll connect it to what the Federal Reserve is doing with interest rates, what housing affordability has done to a generation, and why AI is accelerating layoffs faster than anyone wants to admit. We will talk about why government debt costs keep behaving like a stubborn machine that refuses to obey the headlines, and we will talk about a new kind of backup dollar strategy, not replacing the dollar with a new coin, but replacing the institution that controls the dollar's plumbing. But first, let me ask you something simple. When interest rates go down, why does real life not get cheaper? Not for you. Not for the nurse with student loans. Not for the teacher who is still one rent increase away from moving in with family. If the Fed can cut rates and supposedly relieve pressure, why are prices still crushing purchasing power? And why does the stock market keep rising while your life gets harder? The answer is not a conspiracy. The answer is arithmetic. And the arithmetic favors whoever controls liquidity. Now, let's start with the story you were taught. The global financial system is stable because the United States issues the reserve currency and the Fed manages it. In that story, if the US stumbles, the world gets scared, but it eventually recovers because the US can always print dollars. You might remember the 2008 financial crisis. It happened in the United States, but the pain rippled across Europe, across Asia, across everyone who held dollars, everyone whose exports relied on dollar demand. The world learned that when America sneezes, everyone catches a cold. But the darker truth is this: America did not just recover faster than everyone else. America recovered because it could force money to move, it could expand its balance sheet, it could lower borrowing costs, it could stabilize markets, and it could re-accelerate demand by flooding the system with liquidity. While the rest of the world could not create dollars on command, the US could. That difference is not philosophical, it is mechanical. And once you see it as a machine, you can also see how the machine can be hacked. In 2026, the hacking looks different than in 2008. Today, you have artificial intelligence reshaping labor markets, eliminating routine jobs and pressuring wages. You have central banks still chasing inflation, but inflation has already done structural damage to your ability to buy a home, buy groceries, and keep money working. You have wealth concentration accelerating, with the top 1% owning more than they did before, while everyone else is stuck renting forever or refinancing at worse terms. And you have global debt exceeding $300 trillion, which means the system is running on debt like a city runs on electricity. So where does the money come from to keep everything alive? It comes from confidence. It comes from who is willing to buy government debt at low risk. That brings us to the obsession everyone has: Treasury yields. People watch them like weather forecasts. If the Fed cuts, yields should fall. If yields fall, borrowing costs should ease. If borrowing costs ease, markets should calm down. That is the textbook story. But textbooks do not live inside reality. Reality lives inside auctions, liquidity, and positioning. In the last couple of years, headlines have told you that the Fed was lowering rates, or at least stabilizing them. Yet the yields on U.S. Treasuries at key maturities often refuse to behave like they should. The 10-year yield did not just drift down into comfort. The 2-year yield remained stubborn. The logic failed because it ignores one central fact: the government's interest bill is not only about the rate, it is also about how much debt exists and how much new debt is being issued. You can lower the interest rate on a portion of the debt, but if the government is issuing more debt every month, the total interest expense can still rise. And when inflation damage is worse than what the headlines admit, the market demands a yield high enough to compensate for the future erosion of purchasing power. So you end up with a brutal cycle. The US issues debt to cover budget gaps, the market prices risk, and the interest burden keeps climbing. You ask yourself, why would the system ever allow that to become unbearable? The answer is that the system is managed by the Fed, managed by the banks, managed by the global willingness to accept US dollars as the safest route to survival. Now here is where the story gets truly ugly. Imagine you run a test. Not a public test with fanfare, but a quiet financial experiment. You ask a simple question: what if the world does not react the way it always has? What if dollar-based assets stop being the default sanctuary? What if the demand for treasuries weakens and yields start rising because of a liquidity shift rather than because of bad fundamentals? According to the logic at play, one way to test that is for a government to issue dollar-denominated bonds in an environment where you would expect minimal demand. You do not do it because you need the money for dinner. You do it because you want to see what the market actually believes. Now imagine China running something like that. Not exactly like a movie plot, more like a financial lab experiment. Issue a small dollar amount relative to global holdings and watch who buys. Watch how much liquidity is chasing it. Watch what yield it can offer and still attract massive demand. If that demand appears out of nowhere, it tells you something terrifying. It tells you that the world is not merely buying U.S. Treasuries because of America's economic power. It is also buying because of institution-level access and global positioning. If another issuer can mimic the yield profile closely enough, the risk-free label starts to look less like a law of nature and more like an agreement. And when the agreement shifts, the referee matters. Remember this. In 2026, it is not just geopolitics. It is also supply chain constraints, climate-driven insurance collapses in certain regions, migration and disaster costs, and higher volatility in global energy markets. Those pressures raise hedging demand and risk pricing. Liquidity becomes more valuable. So if a country can offer access to dollar liquidity without losing the market's trust, the default map can change. But wait, you might say, okay, so China issued bonds, why should I care? Because markets do not move just because a bond exists. Markets move because the same dollars have to choose where to go. If investors can get similar yields in an alternative channel, then some portion of the capital that used to flow into U.S. Treasuries can detour. Even a small detour can matter at the scale of U.S. debt markets. The math is brutal. U.S. Treasury issuance is so large that a shift in buyer appetite can create persistent yield pressure. And here is the cliffhanger you need to feel in your stomach. If you ever get to a point where the market requires higher yields just to keep funding the government, the interest expense can snowball. That snowball does not stay in Washington. It leaks into everything you care about: taxes, budget cuts, inflation tolerance, and the cost of capital across the economy. So yes, you should care. Because the next time your rent rises, it might not be because your landlord is greedy. It might be because credit conditions tightened, insurance costs rose due to climate losses, and employers tried to offset squeezing margins by trimming hours or shifting compensation. It all ties back to liquidity and debt. Now let's connect this to the people you are watching struggle. Picture a 32-year-old nurse named David. He is not a conspiracy guy. He does overtime when he can. He tries to invest in a retirement plan because that is what every adult is told to do. He keeps thinking the system is fair enough to reward discipline. Then in 2023, his rent jumps, his car insurance jumps, and the groceries he bought last year suddenly cost more while his raises arrive slower. When the Fed cuts, he expects his life to ease. But his monthly cash flow does not care about a press conference. His housing costs follow a lag, his employer costs follow a lag, and his credit card interest follows a lag. Meanwhile, AI keeps shaving hours off positions that used to be stable. He hears layoffs in healthcare admin roles. He sees new software replacing workflow jobs that he never thought would disappear. So David does what most people do. He freezes, he saves harder, he avoids risk, he buys only what feels safe. But safe is not what it used to be, because safe assets are safe only as long as the buyers remain steady, and the buyers remain steady only as long as the institution that provides liquidity remains unchallenged. And now you understand why financial power does not look like a battlefield. It looks like a bond auction. But there is still a deeper mechanism at work, and this is where anger becomes understanding, and understanding becomes worse. The mechanism is money creation and the way liquidity gets absorbed or released. The Fed can expand its balance sheet and flood the market with cash reserves. Or it can tighten financial conditions by shrinking the balance sheet and draining liquidity. Both actions can influence asset prices and yields, but not in the simple one-direction way people imagine. In 2020, the world learned how fast central banks can bend liquidity. When yields get pinned downward by policy and massive cash is introduced, bonds can rally and yields collapse. But if debt continues rising while liquidity stops expanding, yields can stop falling. In some cases, yields can even rise again even after rate cuts, because the pool of buyers and the amount of money available to chase bonds changes. That is a key insight you were not taught in school. Asset prices depend on both the quantity of assets and the quantity of money trying to buy them. It is like auctions for paintings. If 10 paintings exist, the price is not only about how many paintings you offer, it is about how much money the bidders brought with them. If the bidders show up with more money, prices rise. If the bidders show up with the same money but there are more paintings competing for that money, prices fall. Yields move opposite prices. So if liquidity drains and debt supply rises, yields stop cooperating. Now add another real-world twist in 2026. Debt is not only federal, it is household, it is corporate, and it is global sovereign. And insurance and climate losses are turning local disasters into financial liabilities that show up in credit markets. That means money that might have been chasing long-term stability is instead chasing short-term survival. So when you read that the Fed cut rates, do not imagine a smooth path back to comfort. Imagine a market where the lever gets pulled, but the machine compensates elsewhere. And then ask the uncomfortable question: why are the headlines still framed like everything is under control? Because people need a story, people need calm, but financial systems are not emotional, they are transactional, and the transaction is always the same. Whoever can borrow cheapest, spends longest, and forces the rest of the world to accept their terms, wins. Now let's sharpen the point. If someone wants to weaken U.S. Treasury demand, they do not have to crash America, they just have to chip away at the buyer base enough to raise yields. In that scenario, a country or a coalition could benefit by shorting treasuries through sophisticated instruments. The short does not need a public collapse, it needs persistent lack of marginal demand. And there is the other half of the story. Even if treasuries get pressured, the Fed can respond. It can create liquidity. It can stabilize. It can act as buyer of last resort. So treasuries might not collapse. But the round trip from stress to stability comes with a cost. The cost shows up as weakened currency purchasing power and a longer-term damage to savings. You can be rescued and still lose. That is the trap. The world is trained to think rescue means no harm. But rescue from a crash is not the same thing as restoring fairness. Now here is where crypto enters your life, whether you like it or not. In 2020 and 2021, crypto was sold as independence. You would supposedly escape banks, you would own your keys, you would take control. But by 2026, the reality is much more institutional. Regulated exchanges, custody providers, market makers, and large firms hold massive portions of what is traded. In other words, crypto did not escape the banking logic, it got plugged into it. And if you think this is unrelated to treasuries, you are missing the pattern. When the dollar liquidity system is questioned, investors scramble for whatever still behaves like a hedge. Bitcoin used to be the narrative hedge. Then regulation and institutional involvement changed the behavior. In certain downturns, Bitcoin can move like a high-risk asset because liquidity dries up. Gold can become a hedge, but it is also influenced by real rates and currency expectations. Silver has its own industrial cycle. Everyone is chasing the same constraint: liquidity. So the financial war is not only about dollar bonds, it is about who controls the plumbing that turns savings into stability. Now let's make this concrete with a second micro story. Imagine a software contractor named Priya. She used to earn well. Then AI tools arrived that could draft code, automate tests, and generate documentation in minutes. She did not lose her job overnight, but her pricing power collapsed. Companies told her to do more output with less pay. She saw the contract volume shrink. She tried to pivot into a new niche, but it was a race against models that were learning faster than her hiring market could retrain. Priya did what everyone does when anxious. She parked savings in a safe portfolio. Some cash, some government bonds, maybe a money market fund. She told herself it would protect her. Then inflation did its long-term damage. Even if the headline rate cooled, the cumulative loss to purchasing power kept stacking. Her portfolio did not crash like 2008, but it quietly underperformed the cost of living. And when she finally tries to catch up, she discovers the rules are harsher than she expected. Housing prices did not just rise temporarily, they detached from wages. A generation is stuck renting longer because the math does not work. Climate insurance costs keep rising in some regions, making the dream of home ownership even less attainable. It is not one factor, it is the combined pressure of debt, liquidity, and risk repricing. Now you start to see the emotional core. You are not failing, you are being managed. So where does empowerment come from if the system is rigged? This is the part everyone avoids because it is not glamorous. It is not about feeling superior. It is about becoming harder to manipulate. If you want to survive a world where the dollar's referee role is under test, you need to understand the driver of price formation. You need to understand